Ladies and gentlemen, good day and welcome to the Mech Project Limited Q1 FY23 earnings conference call hosted by Nirmal Bang Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance in the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashil Gandhi from Nirmal Bang Equities. Over to you, sir.
Thanks, Renju, and good afternoon to all the participants. Nirmal Bang Equities welcomes you all to FY23 earnings conference call for Mech Project Limited. From the management team, we have S.K. Ramaya, Director, Business Development, and Mr. Jamie Satish, CFO. Without taking much time, I hand over call to management for opening remarks, post which we can take for Q&A. Thank you, and over to you, sir.
Thank you. Good afternoon all. This is Satish, and along with me I have Mr. S.K. Ramaya, Director, Business Development. We welcome you all to the earnings call Q1 FY22-23. Let me take first to the financial highlights of first quarter 23. Performance for Q1 FY23 continued to be healthy in line with overall plan set for the company. The reported total income for Q1 FY23 is rupees 749 crores. The EBITDA is rupees 86 crores and the reported PAT is rupees 39 crores. Whereas Q1 of previous financial year, the reported total income was rupees 628 crores, EBITDA was rupees 71 crores and PAT was rupees 31 crores. The revenue mix for Q1 FY23 is as follows. Erection business contributed rupees 152 crores. Civil business, including railway, water projects, is around rupees 376 crores. Operation and maintenance, rupees 196 crores. Electrical business, 22 crores, and other income around 2 crores. Whereas during Q1 of last financial year, erection business contributed around 137 crores. Civil business contributed around 284 crores. O&M business contributed 173 crores. Electrical business 28 crores, and from other income it was around 6 crores. Domestic business has contributed almost 83% and rest 17% business has come from overseas business. The mix between power and non-power business stands at 60% and 40%. We have seen growth across all the segments except electrical business, whereas the company is conscious of growing in electrical business space. This is far the best and all-time high Q1 performance for Mech in its entire journey. Reported total income clocked a growth of almost 19% during Q1 as against Q1 of previous year. Similarly, EBITDA has shown a growth of almost 20% and PAT has shown a growth of almost 26% on account of controlled finance cost, depreciation and increase in margin profile. Depreciation cost as a percentage to revenue remained lower side due to controlled capex spending. Similarly, finance cost as a percentage has come down on account of reduction in overall utilization of limits. Overall execution cycle expected to improve further on account of robust order book, stronger engineering skills, construction management and strengthening first and second level leadership in-house. Mech is known for its execution capabilities. From a pure power sector play 7 years ago, the company has transformed itself into a multi-dimensional infrastructure player retaining its core competence in O&M and mechanical pile. As we foresaw slowdown in the thermal power sector years back, post that Power Mech has demonstrated its execution capabilities in every segment we operated so far, including railway, road projects, water projects, material handling, cross-country pipeline, international operations, etc. Another important point to note is that Power Mech has experience in operating in all tough areas, including international territory. During this 23 years journey, including tough period of COVID, the company has built capabilities to deal with any adversity. We have instances where we were awarded few contracts without performance guarantees, which shows the confidence of our customers. On execution front, the company is much confident to deliver on schedule. We are also excited and happy to share new talent from reputed organizations joining Power Mech across all verticals. Few names will include N. Srinivasa Rao, MD, joined as the MD and CEO, International Operation Africa. Earlier he was associated with reputed companies like Thakurji and Palanji. Mr. Umesh Mehta joined as Chief Techno-Commercial Officer, having more than 3 decades experience. He was associated with some of the reputed companies like Vedanta, Sherlight, Waman Engineers. Mr. Vijay Bhaskar Rao joined as Vice President, Contract Management and Business Development, having 35 years of experience. And earlier he was associated with companies like TechPro, Vision, AP Genco. Mr. Ashok Kumar Datta joined as Vice President, and he has almost 30 years of experience, and earlier he was associated with some of the reputed companies like Reliance Industries, Nirman, L&T. So this shows the confidence on the execution front and the talent getting attracted from bigger organizations that gives a lot of confidence among the team in terms of execution. And going forward, the overall working capital cycle looking to be improved. The average monthly collections continue to be in the range of rupees 250 crores to 300 crores, and the same is expected to improve going forward. Net current days, excluding cash and cash equivalent, continue to be in the range of 140 to 145 days during the period. This is again expected to come down during the year. Gross debt and net debt remained controlled despite growth in the business. Overall debt utilization and finance cost expected to come down during the financial year. As you all would have seen, recently Power Mech has bagged a large contract in the space of FGD, which is around 6,100 crores plus from Adani Group for its projects based at Mundra, Tiroda, Kawai and Udupi on a complete EPC basis. These projects are to be executed over a period of 30 months. Power Mech has created a separate unit to handle this project, headed by senior professionals. Also, Power Mech has tied up with well-proven technology partners for technology support and also for equipment supply to install these FGDs and taken all necessary precautions to mitigate all contractual and external risks. The major thrust into FGD EPC business is part of our forward integration and major diversification based on Power Mech's core competence of over 2 decades in power plant installation. Power Mech's vast experience and in-house core strength to handle any power plant will add lot in terms of value addition in execution of this project. This contract have 10% molested advance clause, which is interest-free. Therefore, we do not see any incremental working capital for executing this project if these projects are self-sustained. And the margins are expected to be around 11% plus at EBITDA level from this FGD project. Of course, there is a scope to improve further this because of our inherent strength in similar field. We will deploy need-based equipment in-house and new with a mix of additional capex of rupees 25 to 30 crores, which is part of our capex plan for this year. The order backlog for the company as of today stands at rupees 24,000 crores plus, including MDO contract, and rupees 15,000 crores plus excluding MDO contract. Up to date, during the current financial year, the company added new orders of rupees 6,948 crores. For the entire year, now the company has set target for reaching 10,000 crores of new order additions. We expect to add new orders of rupees 3,100 crores for the balance period of current financial year. As in today, the company is already L1 for almost 1,500 crores of projects. The company has strong visibility for its 3 years growth. During the current financial year, the company is confident of converting order book to revenue of around rupees 3,600 crores plus conversion of revenue from this new FGD contract. We will come with the revised target of revenue for the year in couple of days based upon the FGD work schedule. For FY23-24, the company is expecting to have opening order backlog of rupees 14,000 crores plus. This is excluding MDO contract. The company is planning to convert opening order book to revenue by around 38% plus during FY23 and 24. The MDO project is going as per our original schedule. After 3 years, the company is will consolidate its business model to sustain growth, and the focus will continue to be more on improvement of margins and cash flow. Post 30 months, the company has opportunity of additional O&M contracts of rupees 1,000 crores, which will be executed over a period of 5 years. Yearly, it will add almost 200 crores plus in terms of revenue from the FGD orders and the O&M orders yet to receive. In addition, the MDO contract will start generating revenue. Moreover, the company has built strong in-house credentials and features in the field of railways, water projects, road projects, international operation, material handling, cross-country pipelines, etc. So Power Mech will align its business model, keeping opportunities in line with the NIP. Of course, operation and maintenance, both in power and non-power sector, including international operation, is expected to play a dominant part in our overall business plan going forward also. The promoters are intending to infuse funds into Power Mech by way of preferential allotment, subject to board and necessary approval. Power Mech need non-fund based limits, mainly performance bank guarantees from various banks. Infusion of equity from promoters will build a lot of confidence among the lenders and will also help a lot improving the external credit rating. It will range around 1.3 to 1.4% of pre-allotment equity base and subject to consent of the board and necessary approvals, which will come within a couple of days. Now I request Mr. Ramaya to add few more developments before we move forward to Q&A. Thank you.
Yeah, thanks Satish for your opening remarks and the bringing out the various facts on the company's operations. Thanks everybody. I think on the marketing and business side, as we know, the COVID is behind us, and that has obviously opened up the market in a big way. And that is obviously reflected in the results and the opportunities and the new orders the company is tagging. And last year, at the end of the year, we had a backlog of 8,855 crores. And the first quarter, about 775 crores orders have been booked in the mechanical side and then civil side, and then O&M side, about 155 crores. And that has taking into the backlog of conversion in the first quarter, the order backlog now stands at 8,883 crores. And there is a modest increase based on the first quarter inflow of the orders, about 8.6% in the mechanical and EPC business. And there is, of course, since the conversion has been taken place in O&M, the order backlog stands at 1,203 crores. And then civil and infra, the order backlog is now 5,789 crores. And then electrical, we are not adding much, it stands at 96 crores. Last year, the first quarter, the order booking was 343 crores. This year it has gone up 175 crores. And the major orders which have been received are the Kurja full handling. It is a very good opportunity. We are working with ThyssenKrupp in partnership, 191 crores. Then the Godda 18 megawatt boiler, Adani has entrusted the job to us because of the failure of the existing contractor, about 105 crores. That is going on a fast track basis. Then there were FGD steel works we have taken up at North Chennai from EHL 119 crores. And then sheds construction of the mole from the railway opportunities, 113 crores. And then O&M opportunities, about 155 crores have been put. Apart from that, on bridge construction work of 50 crores and other civil work about 41 crores. So that is what the breakup of 775 crores. The major orders in the pipeline L1 status are the FGD orders for the civil and mechanical installation jobs. About 1950 megawatts at Hardia, Chandrapur, Badjpat for CEST Goenka Group. And we are ranked lowest at 870 crores for about 1950. It is not EPC job, but it is the balanced site execution jobs are there. And then Bangalore Metro, one depot construction is coming up, and that is around 450 crores at Telagatta. Then railway electrification jobs in Mangalore and Hassan, about 88 crores. And then there is an O&M opportunity in Nigeria, where we are already doing the installation job. And it's about 94 crores. So these are the orders in pipeline. Then coming to the business segment analysis, the domestic business stands now with the balance order backlog of 8,361 crores compared to 8,212 crores last year. And the international, not much is happening because our focus is now fully in the domestic side because of various opportunities, 520 crores. The power sector business is around 43%. The order backlog 3,799 crores, and the non-power continues to play a role, 5,084 crores. Now there are two distinct developments which is going to give a big vision for the company in the next couple of years. One is the mine development operation in Jharkhand. That is 9,294 crores for 25 years. With that, the backlog will stand at 18,177 crores as on June. But barring this main development, now the new initiative that happened in the FGD orders as Satish was speaking out, 8460 megawatts for about 15 units of 332, 660 megawatt Adani at various of their projects in Kawai, Mundra, then Udupi, etc. That has the NOI order has been received, and taking that into factor, the backlog has gone up to 15,056 crores, and that also boosts up the power sector and mechanical job presence in the business. And the domestic business has ballooned to almost 96% with a backlog of 14,531 crores. And the power sector business has jumped, which has on the downward trend for the last couple of 4-5 years. And now the backlog goes to 66% of the total order book of 15,056 crores, and the non-power is 5,084 crores. Therefore, this is a very good ground to take off and then have a vision for the next 2-3 years. Major works we are executing in Udangudi civil and structural job 345 crores. Then Buxar boiler for L&T 176 crores. Bhusawal, civil and structural work 285 crores. Maitri, major job in Bangladesh 855 crores. Yadadri, for the 5 into 800 megawatt, any mining packages in civil mechanical, coal handling, 813 crores. Ramayantpet Canal Works 373 crores. And then Sadalpur electrification 350 crores. And the major water projects which we are doing in UP, about 2,775 crores. The present value it can go up to plus 4,000 crores. Then road work, what we are doing in Karnataka and Mizoram, about 780 crores. And then the latest job what we have taken from the Adani in the Khammam Kodar road project in Telangana, 645 crores. And if we add up the FGD in the 4 projects, 6.63 crores. So this is where the company's focus will be the next 2 to 3 years. And the O&M continues to play a role in our bottom line growth and also contributes for the revenue generation. With a major presence in Singareni 343 crores, Tuticorin 2 into 600 megawatt 391 crores. And then non-power jobs also we taken at JSPL 66 crores. And then Jharkhand, Jharsuguda 4 into 600 megawatt 387 crores. And then international also now the focus is on O&M side because we have done a lot of installation jobs that we are expecting about 100 crores. This is the presence in the O&M side. And the manpower side, the company continues to add people, as rightly said, both on the senior level and also the working level to strengthen the execution and oversight of the project execution. And it stands about 32,000 with a contract labor of nearly 15,000. Maybe some more additions have to take place to take care of the new order booking. And as far as the opportunities are concerned, without the FGD, we had a target of 4,000 crores. And with 1,500 crores in the L1 position and 775 crores, perhaps, we'll still be able to achieve those figures without the FGD. And if you add up the FGD, the order booking for this year can go up to 10,000 crores. Therefore, that should help us to understand at the end of 2023, assuming that the conversion of 3,600 crores can go up slightly higher of the Adani FGD order to plus 4,000 crores. The backlog by end of the next year it should stand between 14,000 to 15,000 crores. And that is a very clear working model for us in the next couple of years. And then the major areas of the work are the drinking water project, 2,775 crores. Then road project, 1,650 crores. And then FGD is about 6,163 crores. And then O&M jobs around 400 crores. These are the, and then I think the business, as Satish has rightly said, we have aligned ourselves with the national infrastructure pipeline that is reflected in our order flow in the last couple of 2-3 years. And if you look at the order flow in the last 2 years, in 2021 it was 4,638 crores. In 21-22 it's 4,000 crores and 31 crores. And as based on the projections, yes, including the Adani order, it is certainly possible we can get around 10,000 crores in the current year. And down the line, obviously the NIP investments will continue to be bullish with various investments in infra side, railways, then minerals and mining, then mine development. That is a major opportunity since we already entered there. In fact, Coal India is planning to undertake mine development operations for about 162 million tons. And then drinking water projects continues to be funded well. And out of 19.1 lakh crore of households, 50% have been provided for the efforts of the last couple of years. And we are working in about 3,000 villages in UP. And the one more area for perhaps the long-term vision can be the operation maintenance of the thermal power plants will undergo basic changes with increased capacity addition into renewable power. And by 2024-25, it is expected to go up to 450 gigawatts installed base. And the end of the decade, the PLF, present PLF is stands at 58%. It has come down. It will further go down to 30 to 40%. So in a way, the thermal plants will come under a lot of stress in operation because of the within the generation mix of the fuel, and that obviously calls for different O&M practices. The company is gearing up for that. It's huge presence in about 67,000 megawatts of operating days and working at about 40 plants. And in fact, it is both an opportunity for us to work under these adverse conditions in operating those plants, because in many of these cases down the line, the power plants have to be operated day and night basis. That can add up to the O&M cost also. So in a way, it can be an opportunity. And railways are coming with big investments, and we are already there. Perhaps with the 500 crores of working orders, what we are executing, another 450 crores expected shortly. And then railways is going for 500 numbers of multimodal terminals, cargo terminals, and their station pre-developments. And then the new opportunities, what we are looking at is the metro project. Today, metro is going to be there in most of the A and B grade towns. And the total length has gone up to 702 kilometers and is planned to go up to 700 kilometers. And the opportunity is 280 to 320 crores per kilometer. And then roads, I explained you already, the investment in this year is nearly 2 lakh crores. And there is a compounding growth of investment of 20%. And we are working in about 151 kilometers of roads of 1646 crores. Then as far as electrical T&D transfer and distribution, yes, we are taking a view on that, how to proceed on that because of the competition. We have successfully completed 4 projects, and we are working another 4 projects in Northeast, Bihar and Bombay. And we are watching the opportunities. There is going to be substantial investments in T&D also to strengthen the grid and bring down the transmission distribution water. The investment of nearly 3 lakh crores. And railway electrification is going to be a huge opportunity. And we have completed 640 kilometers of railway line in the Sadalpur section out of 727, and another 80 kilometers we are bidding for that and hoping to get that. Therefore, this is what I can bring out about the opportunities, then order position and the marketing side. We can go for the next phase of the question and answer. Thanks a lot.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Abhishek from HDFC AMC. Please go ahead.
Yeah, good afternoon, sir, and congratulations on a very strong set of orders. So first question regarding the FGD order that we have received. Some understanding on how the revenues will be booked in 24-25, and also if you could give some understanding on the payment terms, how much is retention money?
Yeah. I think this 6163 crores will be spread over next 30 months. And the first year we can expect about 10% of revenue. That is the maximum. Therefore, perhaps 23 and 24, the revenue should, out of this, at least 50% should get converted, 40 to 50%. That can boost up the revenue with the other backlog of orders for the year 23-24, because by end of the year, as I told, 14 to 15,000 crores of backlog will be there. And that should give a vision of 4,500 to 5,000 crores of revenue beyond 23.
Yeah, and so what is the retention money that we have agreed on?
It's around 10%.
Okay, after a year of completion will be released.
No, that is at the end of the completion. Then we can get that payment back.
Okay. And so this commodity escalation clause and margin, how are those covered in this contract?
I think they are in line with the market expectations and the competition, about 11 to 12%. And how the advantage for us is we got more value addition for our side because of our operations are well-grounded with in-house equipment, supervision, and our own construction expertise. And what we have to focus is on the procurement side. And then then working capital should not be a problem because we are getting the advances, and we are going to tie up on matching basis the payment terms with the suppliers also. That is how we are planning to execute this job.
Understood. And I think the comment that was made earlier that next year you are looking at 38% execution on a 14,000 crore order book, opening order book which will be there. So that would mean about 5,300 to 5,500 crore of revenue in 24. Is that understanding correct? And if you could comment on the execution capability ramp up, how the planning has been done at the company.
I think that's a very interesting question. You see, how the execution comes up based on the expertise, as Satish explained, has been brought out for the 23 years. In fact, in the last couple of years, and even the COVID period, we have managed the project much better than our competitors. That's why one of the example I told you, the Godda project, customer has removed the job from the other agency and given to us. Only the resource management, what we are having it, and the strong supervision base of nearly 6,000 to 7,000 engineers and supervisors working online, on-site at site. And then we have got a SBO-based project management approach of focused project implementation, and then delivery management and customer relationship. And for us, handling this many projects is not a challenge at all because we are quite used to work in about 40 to 50 projects. And what we may need in this case will be another modest increase of the manpower, about 5 to 10%. And as far as the resources are concerned, we have got a lot of resources in terms of the execution what we reserve for the coal-based power plant. In fact, we have got excess capacity of the resources in the construction equipment that can be gainfully deployed for all these jobs. And the in-house capabilities in the civil works and then structural fabrication erection works, that also stands good for us. And the erection station jobs is already our basic strength. And then O&M, we continue to play a leading role. That's why we are the preferred customer prefers us. Therefore, I think from scaling up from 3,600 crores the current year, I think the existing resources will be some modest additions. Scaling up to 5,000 crores is not a challenge because, as you know, earlier we were on the range of 2,000 crores. Now we are expecting to go to 4,000 crores in a matter of 3-4 years. And that is how the company is scaling up its capabilities, resource management, and then optimal utilization of the resources.
Understood, sir. And regarding the operating margins, we had highlighted in the previous call that we would expect an improvement led by O&M and also royalty cost is going to go down. So when do we start seeing improvement in operating margins, sir?
I think many of the projects which we are working on joint venture basis, consortium basis are getting completed in another 6 months to 1 year. Then, we will be better qualified to bid the project on a secure basis, on a standalone basis. That should add up to our operating margins much better when we bid for the railways, infrastructure jobs, and many specialized jobs which we are working with others. And that is an exact number at this stage we cannot factor it. But there is going to be some improvements in that.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. Next question comes from the line of Vinesh Cheda from Lucky Investment Managers Private Limited. Please go ahead.
Sir, a few clarifications. You mentioned that the revenue for 23 will be 3,600 crores and revenue for 24 will be 5,000 crores. And bulk of the FTD execution, which means will slow down to 24. Is that correct on the assessment?
I think that 3,600 crores was based on the order backlog of 8,855 crores, what we built up in the beginning of the year.
Mm-hmm.
Taking into account whatever orders they are going to build up in the current year also, excluding the FGD orders. But with the FGD orders factored, that should go up to nearly 4,000 plus crores. And the next year, obviously, the backlog is going up by the end of the year because of the balance of the pipeline of the orders of 1,500 crores plus the FGD orders, what has been backed, plus additional orders, what we are expecting it. That is how that projection has been given beyond 23-24.
So my second question is, you mentioned that on FGD you got 10% advance and there will not be any incremental working capital is the assessment. So which means when you move your revenue from 3,000 to 5,000, the movement in your working capital, absolute working capital requirement is hardly any.
See, it's not much. Why I can say is that, see, in this type of business, you also tie up back-to-back terms with the suppliers. And the rest of the resources we are putting from our side itself, like construction side and all those things. Infrastructure input. Therefore, that is already available. That doesn't need the investment. What is required is the ordering on the supply packages, and those things we will try on a back-to-back basis with matching advances and all. That is how we are able to figure out without much of this labor.
Okay, so is this assessment correct, right? Whatever is the absolute working capital today, and when you move your revenue from 3,000 to 5,000, the absolute working capital requirement will not rise in sync with the revenue.
It will not.
Satish, can you...
10% Molech advance clause, which is interest-free, Neatwork will utilize. So see that this project is going to be self-sustained. So it all cash neutral.
It will be cash neutral.
We don't envisage any additional funds pumping into this project.
Okay. And so my last question is, are these FGD orders one of which takes you to these kinds of backlogs and revenue, and post 24 we see a tapering off, or do you see this higher base, or what are the levers for this higher base sustaining?
I think, see, company has diversified a lot from what was 5 years back, 10 years back. And we are quite confident, of course, these are all one-time retrofit jobs. The 50% has been ordered, balance 50% is in the pipeline, and there we are targeting under 2,000 to 3,000 megawatts. And that also should help us.
Megawatts, sir?
About 1,69,000 megawatts is identified retrofit. In that 50% has been ordered already in the market. Balance 50% is under the ordering process.
Okay.
And these ordering will be completed in the next 6 months to 1 year, perhaps. That is to keep the deadline. Maybe the deadline of 2024 may not be fully possible. It can go up to another 12 to 18 months to take care of the balance order booking and execution and all. But what your question specifically, I agree. What will be without the FGD in future? I think today the company is into infrastructure area, O&M side, we are expanding in non-power sector, in the international market also. And then in the railways, we have made a big presence, and railways investments are going to be continuous, and they are investing more than 1 lakh crore per year. And there are many jobs which are to our product or service profile, depots, maintenance workshops, and then railway civil work. And therefore, railways is an area. Then road projects we have already established, and we are working with our own capabilities, and that will continue to play a role. Therefore, I agree. Definitely, if the opportunity is available, and then more importantly, the private sector is coming with big investments in steel infrastructure and then the mining and metals. And what I can say is that the mining is going to offer a lot of opportunities. Today we have taken a mining development project of 5 million tons. Our plan is to increase to 15 to 20 million tons in the next couple of years, 1 or 2 years. That should give us a lot of top line growth and also bottom line in terms of the O&M business. Perhaps if this MDO once implemented from 2024, it should add to 400 to 600 crores of additional revenue on the O&M side. And we are looking another 1 or 2 projects, another 10 million tons. That should further take up the revenue to 1,500 to 2,000 crores. So we are having plans for filling up these gaps. We know these are all the opportunities. And then the infrastructure side, I don't think there is getting slowed down in the there. It's always going to be the upside only the investment. And the company is rightly caught up with all these things. And that's how the order booking is coming.
Yeah. This FGD has got a follow-up O&M of almost 1,000 crores. That's for 5 years. So that will open 200 crores per annum. On top of that, this MDO project will stabilize. These 2 projects itself will add 1,000 crores top line after 3 years. So That is, once the FGD is over, post 3 years, we'll consolidate, plus this 1,000 crores will supplement. On top of that, the PQs now what we have built in-house, that will help a lot in terms of bidding for larger projects. So we'll see that in terms of number of projects, because today we are operating 112 projects including O&M. So we'll see that the size comes down. Of course, O&M will continue, so the number will be always larger. And based upon our PQs, we'll target for larger projects. So this will help a lot in terms of our sustaining the growth going forward too. So we'll consolidate after 3 years where to move forward. And of course, the focus will continue to be on margins and cash flow because that is important. Yes, sir.
Sir, lastly, sir, this out of 69,000 or out of 80,000 megawatt which has been ordered, what is the megawatt that we have got, and our line of business here is largely mechanical, civil and erection, including the equipment or without the equipment?
No, this job is a complete EPC job, 8,460 megawatts for about 15 units of 330 megawatt to 660 megawatt. And it includes engineering, procurement, construction, then civil, structural, mechanical works. And then the technology partner we are going to rope in there. And there is the key equipment for the process equipment for the absorption and the technology part of the FGD, that will be supplied, that will be sourced from them, and rest of the installation work and the sourcing we will do it ourselves. And the civil and structural and installation we do completely. That is how the plan is. Therefore, it is well fits into our business model.
Okay. Thank you very much.
Thank you. The next question comes from the line of Rohit Natarajan from Antique Stock Broking. Please go ahead.
Yeah, thank you for this opportunity. Congratulations on this fantastic order. So my first question is more to do with the L1 that you have identified. It's almost like 1,500 crore. Can you highlight on what exactly these orders are and when exactly is expected to be part of the order backlog?
Sorry, can you come again?
The 1,500 crore L1 order.
Yeah, I told you, in this there are about 7 FGD orders, of course not EPC orders, they are construction orders, about 1950 megawatts for about 870 crores, that is from the Goenka group of CESC, at Haldia, Chandrapur and Barjbat station, of 300 to 350, 250 to 350 megawatt units, 7 units. And then Bangalore Metro report, we are L1 for about 450 crores. And then railway electrification job in Bangalore orders for about 88 crores. And then one O&M job in Nigeria, here we are already doing the installation job for the Dangote, about 94 crores.
Okay. And sir, you also said that additional you are finding 3,100 crore kind of opportunity over and above what we have won so far.
No, what I said was that we had a plan about 4,000 crores. In that, 7,050 has been already back in the first quarter. I'm talking about excluding the FGD, and then we are pursuing opportunities worth of nearly 70 to 80,000 crores of opportunities in power, civil, non-power, electrical, O&M, water, and then road, etc. Therefore, we are pretty confident maybe another 1,500 to 2,000 crores should happen apart from what is the orders in the pipeline, more and above the FGD orders what we are doing.
Right. So one more question is on the fund infusion fund that you're talking about, professional development. How exactly can this improve, if at all, any credit enhancement that you're thinking, either in terms of bankers giving you better non-fund based limits, fund based limits? What exactly is the picture over there, sir, if you could throw some light on it?
Normally, we don't need fund. In fact, we are trying to bring down the fund base. So what importantly is required is non-fund in terms of bank guarantees and all. So we have got close to 1,650 crores of limit. Of that, the utility is around 900 crores. So we have kept the limit to support our growth. Any good project comes, so I should be ready to support the non-fund based limit. So this will help in terms of infusion from the promoters. as a backup in terms of long-term equity, so that gives a lot of confidence to the bankers while they do the assessment for the non-fund limit. On top of that, that helps in terms of improving the internal trade rating for the bank, so we can negotiate for better pricing, and will also help for the external rating. So that is
Okay. So if I understand it correctly, say let's assume 100 crore is the order, you would typically require a 20 crore kind of a non-fund based limit. Is that the right way to look at the non-fund based limit?
Now today it's ranging 3 to 10%, okay, project to project. So on average we can take 5 to 7% of PPG.
So 5 to 7% would include what all things like your EMD, or maybe the performance guarantee.
See, the EMD when we quote for the project normally it ranges 1%, but once the contract gets awarded, so that the EMD will be released. So what continues is the PPG performance bank guarantee of 6 to 7% or maybe 5 to 7%.
But what about the mobilizer advance? What the client gives you, you will have to give some guarantee to that as well, right?
That depends, because if we wanted to draw mobilization advance, it depends on the customers to customers. Either it comes by way of a upfront mobilization advance or milestone based advance. So because
when you say that you don't require much of incremental working capital, I thought maybe you are looking more to play with very aggressively on this mobilization advance. So which means your need for non-fund based limits will be much higher.
Yes, if we draw, yes, we need. For which we
So if I see the current unutilized limit is maybe some around 700 crore, and if I go by the 20% metric of non-fund based limit, probably your limits are like largely exhausted, right? I mean,
not all the contracts we take the advance. For example, BHEL, every contract has got a clause of availing 10% mobilization advance, which we don't draw because it carries 14% of interest. Now we don't take it. So it huge. It ranges around 20 to 30% or 35% of the total project. Not all the projects will avail that, and not all the projects will have that clause.
Sure, sir. Got it. Thanks a lot. That's it from my side. All the best for you.
Thank you.
Thank you. The next question comes from the line of Vivek Hinduja from Thrive Capital Partners. Please go ahead.
Hello everyone. Thank you for the opportunity. Sir, I wanted to ask that in the first quarter we heard reports of income tax raised on the premises of the company, including that of the top management and the promoters. If you could put some light on the same, it will be great. And also, has the IT department done any monetary claim on the company as a result of these raids?
Yeah, see, 13th July to 17th July, they had search under section 132. It's a search actually to different premises. Now the matter is going on. Income tax department, whatever the information they're asking, we have been providing. This they have come regarding some subcontractors pertaining to some projects where they had some concern. Okay, even they have gone to multiple companies, including Power Mech. So we are providing all the information. Such till the matter is going on. It may take some more time. Of course, this will not impact as far as our operation is concerned, and we don't see any impact measured on our financials.
Okay, because sir, as per the media reports, we heard about some incriminating evidence being found on the premises. So if you could throw some light on the same or give some clarification.
Yeah, the media even we have come across, because I do not know where from they get information and all, but honestly it's not that the case. Okay, it is it's complete speculative, because the information sharing and all still going on. It's a continuous process. It may take another 3 to 4 months. So we are supporting with all the desired information with regards to contractors, projects, wherever they need it. The matter is going on.
And no claim being made, okay, as of now?
Because it takes time, it's the information flow and all, it will take time. We need to provide all the desired information to the satisfaction of the department. So based upon the information flow, the case will be settled. So it will take some time, sir.
Okay, thank you very much.
Thank you. Next question comes from the line of Dikshit Doshi from Whitestone Financial Advisors Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Firstly, one clarification from this FGD order of 6,100 crore. Does that include 1,000 crore of O&M?
No, it excludes. It excludes.
So that 1,000 crores is in addition to 6,100 crores, that order has to get.
Okay.
So that will be a follow-up opportunity to the FGD.
After the commissioning. After
We
the
have not
commissioning.
received that order. It will be tendered and
It's been tendered via L1, but the awarding part they have broken into two components. Immediately they have given the FGD, the EPC part of 6,100 crores. The follow-up 1,000 crores they will award later.
Okay.
That is the opportunity of 200 crores per annum in terms of O&M.
Okay. My second question is regarding this MDL project of Coal India, MDO project. So from when the revenue will start flowing in?
24 Q4 onwards, sir.
Q4 FY24. And as on today, how much is the current and net debt, or gross debt and net debt?
Yeah, today we have got close to 490 and net is we have got deposits of 150, so around 340 crores net, which is expected to come down.
Okay, and one last question. As on today, how much would be the retention money on our balance sheet?
It's around 315 crores.
300. Okay. Fine. That's it from my side. Thank you.
Yes, thank you, sir.
Thank you. The next question comes from the line of Ankur, an individual investor. Please go ahead. Mr. Ankur, please go ahead with your question. Mr. Ankur, if you have muted your line from your phone, please unmute yourself and go ahead with the question. Since there is no reply from the line of Mr. Ankur, we'll go with the next question. And it comes from Faisal Hawa from HE Hawa and Company. Please go ahead.
So my question is that in the order that we have now taken on, what is the ROC and the ROE that you are targeting for the orders which have been taken in the recent 1.5 years? And will you be benefited due to the current commodity decrease in the recent 3 to 4 months?
Yeah, see, these are not pure cash contracts. Okay. So in terms of margins, it will range 11% plus. So definitely, we don't need to invest much except the capex of 25 to 30 crore. So it will help a lot in terms of improving the both ROE and ROC because we don't intend to increase any debt. So that will help to push ROE also.
And what is the ROE which will come ultimately, say, 1.5 years ahead from today?
Sir, it will definitely, my assumption is it should cross 18 to 19% plus, sir. Blended.
I can't hear you.
18 to 19% plus blended, sir.
And sir, we are looking like, we are going into so many sectors, So what is the risk management, you are now taking into, so that, 2 or 3 projects going back or some government intervention in those projects doesn't affect the company. So can you just list out the risk management, principles or steps you have taken to really, protect the company from, going backward?
Can you repeat? Sorry, the voice is not clear.
So we are now going into many sectors, many of them are unrelated sectors. So, what are the kind of risk management measures we are taking to avoid the company going backward?
Yeah. So for our industry, it's one, the execution, second is the service, and the third one is the material component. And we step in as a contractor, so normally everything in place, then we step in. So most of the risk gets automatically mitigated. Now, service component, of course, the manpower plays a key role. So we see that the price variation clause is well protected, so that for any changes in the labor and all, we are well protected. And the second part is the material component. Again, we have seen last 2 years there is abnormal changes in the prices. So whatever little bit cost impact we had, we have observed that. Now going forward, the projects which we are quoting, we have taken a call unless until it's well protected in terms of price variation clause escalation. We are not bidding for those type of projects. And more importantly, once we execute and the payment part, okay, the experience been once upon a time the receivable cycle used to be 45 to 60 days, that went up to 90 to 100 days. Now it's coming down to 75 to 80 days. And we are very particular about the customer in terms of the funding, the healthiness of the financials, so that we are executing and we are getting paid on time. That's very important. So we're choosing projects wherever the payment cycle is in the range of 60 days maximum. Of course, it goes up to 70-75 days. The recent projects been always all are 30-40 days maximum. So the idea is to bring down the working capital cycle as much as possible. That is one of the areas where we are more serious about it.
Sir, and what is our order book ratio from government to private? And how is the competitive intensity in government orders presently? Is it very competitive, and are people even quoting less than the base price? And how many orders have we lost in the last 3 to 4 months to very aggressive bidding?
No, let me explain it. I think there are different segments in this. Mainly the mechanical business, we are a leading player, and we bid based on the margins what we can protect it. And as I told in some of the jobs, customer has terminated the existing contract, given the job to us. So that has happened in Kota. Then we have got leadership in this installation business, mechanical business, and then civil side also there are a few players out there. But even in that case, in one of the jobs in Udangadi, a job has been terminated and given for around 275 crores. Therefore, the competition is there. We are able to manage those competition, and we quote with what is the expected our cost, and then our margins are there. And we also, particularly in the private side and the O&M side, we have got a preference because of our execution capability and conversion capability. And that's good. We get a preference in the case of O&M side also, and then in some of the private players also. But yes, the competition will be there in the government projects. We cannot avoid that. But there are a lot of opportunities. Even if we can get a hit rate of 15 to 20%, it is okay for us. And we are prepared for that type of hit rate. That is what it is expected in the market when 7 to 8 players are there in each of the segments.
And see, Mech, since inception, it's quite conservative. So not taking any projects, with undue risk. So we are quite selective, and the strategy always continues to be conservative. We are comfortable, we'll take the order. If we see there are some risk elements where we are not comfortable in terms of execution in the customer or the location, left out of the project. So the approach of conservative still continues.
And what is our proportion from private orders to government orders?
Yeah, I can take around 50-50. Of course, with this FGD order, it change. We have to rework on that. That is how it is. Most of the infrastructure projects are in government sector. Coal India also? Yeah.
That's because now they are doing pretty well.
Thank you. The line of Mr. Hawa got disconnected. We'll take Rishikesh now from Robo Capital. Please go ahead.
Hello, I'm audible?
Yeah.
Hi sir, one question from my side. If you could please provide EBITDA margin guidance for FY23 and FY24.
So now it's working around 11 to 12%, and we're seeing that margin profile to improve further. And as we discussed, like the projects which we are quoting directly, so it can help us to save in terms of cost for borrowing the credential and all. That will also help for adding EBITDA margin. So we're expecting the margin profile to improve gradually.
Okay, thank you very much.
Thank you. The next question comes from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir, for the opportunity, and many congratulations for the good result. Sir, just wanted to check what's our current execution capability per month in rupees crores?
So now it's well set. It's in the range of 750 to 1,000 crores. It can be increased even up to 1,200 crores gradually.
750 to 1,000 crores up to 1,200 crores per annum.
Per quarter.
Yeah. 1,000 crores per quarter. That is the range. Now, for the FGD, we have created a separate unit headed by senior professionals. The team is well set now. Okay. So this should gradually move up.
Correct. So the reason I was asking that is because, given the revenue outlook that we have for this year, ideally given the second quarter is generally lean. So our second half execution per quarter should be close to about 1,000-1,200 crores, right? Unless we have that, we won't kind of execute our annual target, right? So
in 4 quarters in any financial year, quarter 3, quarter 4 will be always robust. Okay. Comparatively, if you see, it has moved quarter 1, quarter 2. It used to be in the range of 450 to 500 crores. Now it moved to 600 crores, and now this has moved almost 750 crores, which is all time. Okay, in the Power Mech journey. And Q4 last year we did close to 900 crores. Okay, so this 900 crores to 1,000 is well tested now. So what we need to work is to improve further. Now we are working on the creating of the resources, infrastructure to sustain the execution.
Okay. So basically, since 900,000 crores we have already done, so incremental maybe 200-300 crores might be required by fourth quarter. By third, fourth quarter, to increase your execution capability, given the kind of outlook we have, right?
Yes. It's now 900 crores is it's already tested the quarter for last year. Okay, and this year the target what we have kept is more or less it's quite comfortable, because incrementally you'll see quarter 3, quarter 4 will add more volume in terms of absolute number. Okay, gradually you'll see that number going up further.
Fair enough, I understood. Yeah. Yep, that's it from my side. All the very best, sir. Yeah. Thank you very much.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Once again, a reminder to all the participants that you may press star and 1 to ask a question. Next question comes from the line of Ankur, an individual investor. Please go ahead.
Hello, thank you. So my question is with regard to the notification given to the stock exchange today that there will be a board meeting for potential issue to the promoters. Now, we know the company is at an inflection point. The profitability, revenue, everything is going to be very, very good over the next 2-3 years. So at this point, For the company to go ahead and give preferential issue to promoters is not really minority shareholder friendly. What would be nice is to have a rights issue which is given to all the stockholders of the company. If somebody subscribes, fine. If not, then promoter shareholding can go up. So that's my humble submission to the promoters.
Yeah, we'll take a note of it, sir. Thank you.
Okay, that's it for me.
Thank you, sir. Thank you.
Thank you. As there are no further questions, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Yeah, Ramay Garu, you want to add something?
Yeah, I think a lot of things have been covered up. I think we have got a very clear vision for the 3 years, and then the issues which can come up of the third year, perhaps we are geared up also in both the marketing side, business development side, and then the most important, the operation side. Therefore, company is well set for 4,000 to 5,000 crores of turnover in the coming year. And what is important is to sustain the growth, and then the new opportunities will be there in infrastructure, O&M, mining, and then railways, and then international operations also. We'll focus it now as the COVID things are behind us. Therefore, I think this growth story will continue for the next couple of years. And the operations wise, we are fairly comfortable with the present setup what we are having it, and adding the headcount, critical headcount, and also the capabilities wherever is required in different areas. That should take care of our conversion and then working of the project. Thanks.
Thank you. On behalf of Nirmal Bang Equities, that concludes this conference. Thank you for joining us. You may now disconnect your line.